All right, for everybody who stuck around for the second panel session, welcome back. And as they say in the classic movies, wait, there's more. We have a second panel ready to go. If you could please welcome KERRY Series of NorthStar Impact, Andy Forster of Argo, and ELISE Kennedy of Schroders. Wherever suits you, panel, there you go. You can all grab a microphone each, and we'll get going with the second panel. I think we've got Andy, ELISE, and KERRY in that order, left to right. Okay. This particular panel session, we're going to start with basically a whole flurry of stock picks in one go. We're going to leverage the most important market meter categories as scored by research participants, and they are in order: effectiveness of CEO, execution of strategy, credibility, earnings quality, and sustainable competitive advantage. And what we've asked the panel to do is to pitch one stock in their portfolio they believe best represents each individual category, and they get 60 seconds each, so not a whole lot of time. Let's see how this goes, everybody. All right, first topic, effectiveness of CEO. KERRY, go. Which stock did you nominate and why?
I'm going to go for SciDev.
No, hang on, I think we... Away you go, yep.
Okay, I'm still going to go for SciDev.
You are, I never would have guessed.
The CEO is Sean Halpin. The company provides services and products for water-intensive industries, helps with the recycling, reuse, efficiency of water usage. But where it gets really exciting is that they have a clean-up solution for PFAS, which is the forever chemicals. And what's great about Sean is he was the founder of the PFAS business that went into SciDev, which he started in 2016. So he was, he was ahead of time. It's now a massive opportunity. In their latest deck, they talked to a $250 billion US opportunity in America alone.
Okay, there you go, SciDev. Andy, we'll bring you in now. One stock with an effective CEO. Which one is it and why?
Sure, I'm going to go with Tim Ford from Treasury Wine Estates. We think he's done a really good job in being able to pivot that business. It was actually funny, during the time, I think it was in 2020, we were actually in the middle of a one-on-one meeting with them, and we saw on our phone, hold on, we saw China had suddenly slapped really punitive tariffs on the Australian wine industry. And we think Tim did a really good job being able to pivot that business to grow, obviously, into alternative markets outside of China, while still maintaining a footprint in China, which obviously subsequently tariffs have come off, and he's been able to obviously re-engage in China. And I also think more broadly with the business, he's moved it from more into the premium end of the market, away from things like bulk and commercial wine. He's done a really good job of developing some really good brands. Everyone knows Penfolds obviously bought some other brands, but he's really premierised that portfolio, so it's less cyclical in terms of impacted by what's happening in the agricultural space. So he's really developed what we think is really a premium brand company today.
So we started with water, we went to wine. ELISE, I'm interested to see where you go with this. What's a company with an effective CEO and why?
I'm going to pick out Xero on this front, just Cassidy and there, having seen its tenure from founder moving on through another leadership and now a new leadership as of, let's call it, couple of years ago. And why I choose this company is the meaningful free cash flow and the delivery around the OPEX, which is a unique thing for a tech company. And within that as well, putting in those LTIs on that front within her incentive scheme and taking that initiative. And it's clear as we start to see it move from a position of no cash flow to, even in the last half, about 200 mil free cash flow, and that being more of a metric and meaningful metric than, say, an EBITDA, but also not forgetting that they are a tech company with the rule of 40 being in there, so gets harder every year the bigger you do get, but the combination of those two factors for me is one of those effective CEOs.
Okay then, ELISE, let's stay with you. Our next subject, or next category I should say, execution of strategy. What's a company you've been impressed by in terms of their strategy execution and why?
The one that I keep on being surprised reinvents itself is REA, and the ability to keep on getting more out of that market. Now again, if you go back towards 2012 when it was a subscriber-based market, and that was the market that they had the customer subset paying, moving towards now a vendor paid market, leverage more towards the house price, and then moving into the mortgage market, again, just being able to continually execute, change their strategy, keep on growing.
All right, so REA Group there. KERRY, to you, sir. company that's displaying excellent strategy execution. What is it and why?
So the company's called AI Media. The company's been around for over 20 years, and it was founded by Tony Abrahams. His partner was profoundly deaf, so the company is a captioning company. In 2021, they made an extremely important strategic acquisition of a company called EEG, which essentially owns the encoders, the hardware that's in all the media companies used. And then that hardware is then open access to any company with a transcription captioning service. AI Media subsequently have evolved their product, so it is now, in our opinion, in their opinion, market leading, the highest accuracy of non-human, and they actually think it's now exceeding human captioning. But they also own, they've got the pipes as well as the software. So it's really paying off. The company's just turned to profitability. Earnings are growing strongly. They put out a very bullish forecast. Market cap's about 170 million. They're targeting 60 million of EBITDA by 2029.
And I guess you think they're going to get there.
Well, the existing captioning market is $1.8 billion, but and everyone would know that captions are now everywhere. It's an Asian population issue as well as a social media issue. But the speech to text and speech to speech market is a $28 billion market. So their ambition of 60 million still looks small in the scheme of the overall market size.
All right, thank you very much, Kerry. Andy, one company with a great strategy and great execution. Which one is it and why?
I'm going to go with Reece Group, which has been a long-term holding for us. It's a founder-led business, absolutely dominates the plumbing distribution space. Very, very customer-centric business. Amazing management in terms of supply chain, logistics, uses a lot of technology as well. If you ask any plumber, it's the go-to place where they go to get all their plumbing gear. And if you've done any, sure if people have done any renovations at home, it's hard to beat Reece as a place to go for that. And it's interesting, they've got a thing called the Reece Way. I think there's 10 principles. And one of their principles, it's very entrepreneurial within the store managers in their business. And one of their things, I think, is create customers for life. Like this business is very, as I said, very customer-centric. They've moved into the US. I mean, they spent a decade looking at that market before they've moved in and been very measured going into that market. And, their execution to date has been outstanding. They're not relying on an investment bank to bring them a deal and tell them how to get into a market. They're growing it themselves, very measured way. And they are thinking multi-generational decades of how this business is going to be positioned into the future. So for me, that's a company that's had an outstanding execution of strategy.
Correct me if I'm wrong, family founded and owned or was?
That's correct, yeah, still pretty significant family holding there and influence.
Okay, Andy, let's stick with you for our next category, which is credibility. Now, credibility in this context is more kind of the perception or the reputation that a company has or a company's management has in the investment community. Andy, what is one company that is highly credible, if you like?
I mean, it's a little bit big and boring, but I'm just going to go with Wesfarmers for us, which we think as a company is, it's really outstanding. If you look operationally, how they manage, I mean, everyone's obviously familiar with businesses like Bunnings and Officeworks, but, they really are an outstanding retailer in how they operate in their space. I think very good allocator of capital in their business, strong history of earnings growth, consistent dividend payer, good balance sheet. And as I said, on the credibility side, I think, Rob does a great job communicating that to the market. ESG, very sound on that front. It's one of those companies that consistently sort of meets or exceeds expectations. It's very rare to have a disappointment from a company like Wesfarmers.
And the price tag to go with it. Elise, to you now, a highly credible company, and why?
But I'm going with car sales on this one. I think is their execution strategy when it comes to offshore is unique versus some of its peers in the online media space. And sure, they may have said that they paid a higher multiple for the Trader Interactive acquisition, but what has come through is a replication of their strategy that they've duplicated and putting that over into the US, even though the market is struggling. And so that for me is something where the credibility of the management says what they're going to do and execute, and that to me is a unique capability there. But then also they give their guidance and they try and always continually on an ongoing basis update them, whether it's broadly based. Some get frustrated that they say good, extremely good, very good. But again, that does give them the wiggle room, but at least a little bit of guidance, and continue to deliver on that. They've had only a few downgrades or even upgrades more recently, and I think that's really what's delivering on their share price.
All right, thanks, Elise. Kerry, you can finish this category up. Credibility, sir. Which one would you pick and why?
So sticking at the small cap end of the
Sure.
market, I'm going to go for Aspen Group. So run by David Dixon and John Carter. Aspen Group is a provider, a developer and owner of affordable housing. So their target is average selling prices of no more than $400,000 or average rental price of no more than $400 a week. They've built an amazing business, and in such a much needed part of the market, consistently met guidance and typically upgrade 1 to 2 times through the year.
Okay, thank you, sir. We'll stick with you for the fourth category, which is earnings quality. Quality seems to mean something different to every fund manager. So what's one company you think is quality earnings and why?
I'm going to go for SDI Group. So SDI Group, family founded and owned. Jeffrey Cheetham founded the company, and it's now run by Samantha Cheetham, his daughter. They still own over 50% of the company. It's a dental products company. It's it's sort of an unknown, amazing Aussie success story. It's a global company with market-leading dental products. They're very good at guiding market to where the earnings are going to be, and very good correlation between operational cash flow and reported earnings.
Okay, thank you, sir. Elise, we bring you in now. One company with high earnings quality. What is it and why?
If it's okay, I'm going to go the opposite way on that spectrum, being the contrarian fund that Schroders is from. So what I'm going to suggest is things that actually are some of the challenges that we do face, and that namely I might look at towards the earnings quality when it comes to the capitalisation, again, of R&D, and not putting that through, yet having EBITDA as your metric, and or the same when it comes to the depreciation of rents, and that being something when we're looking at the pathology players and the importance of, if you're going to go out and put something in the market but you're going to overpay a rent for it, I think that's something that we need to consider. So I know that's not something that we are looking for, but it's something that I think is increasingly important as we start to see some of the players, particularly the tech names, coming into the stronger into the index. That's an important quality we have to look out for.
Okay, fair play. Andy, to you, one company with high quality earnings. Which one and why?
The one I'm suggesting has been mentioned before, and I'm not suggesting from a valuation perspective, but it is hard to go past the earnings quality of Commonwealth Bank. From the perspective of company clearly dominates the retail banking space, very strong in mortgages, absolutely dominates the deposit space, which gives it a funding advantage. It's the dominant primary financial institution for people in the country. Clearly, very low bad debts. It's got a very strong balance sheet. If you look at the earnings volatility of this company, it's been far less than all the other banks. Been a far better manager of capital. It's as I said, got a far higher ROE. Hasn't had to raise equity. Look, not saying it's got a lot of earnings growth in front of it, but it's hard to fault it from, again, technology. And you look at cost to income's really the leader in the space. So. And it's obviously clearly been reflected in the share price of late, which is, it's clearly had a phenomenal run, but I think that really reflects that it, really is a high quality company within the Australian market.
Okay, last one, and Andy, I'll pick this up with you again. Sustainable competitive advantage. What company has that, sir, and why?
I'm going to go with Technology One, which is more in ELISE's probably space, but it's a software, it's an enterprise software provider. Has a SaaS platform that it predominantly, its key space is in local government councils and universities. It absolutely dominates in that space, and it's incredibly entrenched You know, very low turnover once they get in with a council. I mean, people are familiar with all your sort of, if you go to the council, a lot of the software, things like your garbage truck coming around, they can tell you if you say, oh, my garbage truck didn't turn up, well, they go, hold on, we came past and your garbage bin wasn't out the front. So these guys have got amazing technology, very innovative. You know, they're providing a lot of efficiencies for councils, and also they do it to universities as well, and cost savings. But, you know, for us, that's a business that's, you know, really has got a sustainable competitive advantage, a lot more things that it can offer customers over time, and, you know, big addressable market and lots of other areas they can continue to grow into.
All right, Andy, thank you very much. Elise, to you, what would you say?
I'm going to go with Telstra on this one, going back to my telco days and having covered this for such a period of time, having watched them early in the investment of that 5G phase and how that has really given them that headroom and ability to just keep on getting that extra edge over some of their competitors that were more focused towards the industry consolidation. Not that given yesterday's acquisition that they're not in that space, but they do, you know, continually have the balance sheet as a result, I think, of that investment, and that competitive advantage enables them to therefore effectively operate somewhat like a monopoly, as frustrating as a consumer that can be when you are to the regional bushes and there's no reception. I do think it makes it a really hard point for the others to come through, and therefore has created that economic moat that we look for in a lot of our stocks.
Yeah, I get ticked off when I see my phone bill. I'll tell you that for free. Kerry, to you, you can finish this up. One company with that sustainable competitive advantage. What is it and why?
Well, I'm going to go with a small cap pharmaceutical company called Botanix. They received FDA approval earlier this year for their drug Sofdra. Sofdra treats auxiliary hyperhidrosis, which is excessive underarm sweating. I'm
glad you clarified that, thank you.
Which is actually a neurological disease. And so their drug received approval. It's now being launched into market. It's very clearly more effective than anything else that was on market, but primarily because the alternatives that have been on market were very strong deodorants and also injecting Botox into your armpits. This is a topical treatment which is shown to be extremely effective. So the process of clinical trials and getting through FDA is obviously a very long, extensive, expensive process. Once you've got it, you have a sustainable competitive advantage for a long time.
All right, thank you all. That was extremely comprehensive. Let's move now to our second segment of this panel, and we're going to leverage some of the qualitative responses that have been submitted to MarketMeter research. And here's the first one, team. Companies don't always perform well and don't always provide great transparency when they don't. One investor commented in MarketMeter's research that, and I quote, "I feel like the investor relations officer is sent out to fight the Roman army with his bare hands at times. A lot of bad results and no explanation. I feel sorry for them." So, with that said, and Elise, I might start with you on this one. How long do you stick with a stock that is underperforming, and what do you expect from the company's communications around that performance?
I think I'm fortunate position being at Schroders where we are longer term investors than some of those more momentum orientated. And an example I can give is Seek. So obviously we've gone through the ups and downs of the COVID jobs volume and cyclicality, but that is exactly that, it's cyclicality, and they use that phase to be able to reinvest, which, you know, if you are there for the long term and we are wanting to support competitive long-term sustainable businesses, then weathering through that storm is something that we should be backing. And with that, that's where the fundamentals around communication are key. There could have been some perhaps things that were better guided, but we were guided, here's the investment, here's the unification costs, here's where this cost starts to come out. It's really now a matter of a challenge through the cycle, but again, if you are clear, here are the areas of cost out that I have, here are where I'm going to even potentially get some revenue benefits. That, to me, enables the types of funds that are there for the long term to be able to take advantage of that.
All right, thank you for that. Kerry, where you're focused in small caps, I know what sticking out in small caps can be like. How long do you stick with a stock and a small cap that is underperforming? And I guess what do you expect from company communications as well when performance doesn't quite live up to where you thought it would be?
Yeah, so the obvious answer is it depends. So clearly the question when a company disappoints or the share price underperforms is whether this is a challenge to our entire investment thesis, and particularly at the small cap end, whether it's a threat to their funding position. Often our assessment with small caps is, is this disappointment, will this mean they will have to come back to the market to raise more capital, and will that significantly dilute existing shareholders? So that's often a trigger for us to sell. But on other occasions, I think a great example of our long-term view of investing is a company like Clarity Pharmaceuticals, where they IPO'd in 2021 at $1.40. By 2023, the share price was as low as 50 cents. The management had been proactive through that time, engaging with shareholders, or certainly engaging with us, and we remained highly confident in their ability to execute. From 50 cents in 2023, the share price hit a high of $8 earlier this year. So, we take a long-term investment horizon. If the investment thesis is still intact, we'll stick with the company.
Be honest, did you have to have diamond hands when it came down to 50 cents?
Well, in that one, I'm actually, and this certainly doesn't apply to many of all of our investment decisions, but on that one we did actually carry on buying. Didn't manage to buy any at 50 cents, but we certainly carried on buying down below $1, and we still hold a position, but we've subsequently taken substantial profits from the position.
All right, fair play to you. Andy, I'll pose that same question. How long do you stick with a stock when it's underperforming? And what do you want to hear from management when it's not going so great?
Yeah, well, again, as we sort of discussed, it really depends on what's the cause of that underperformance. Clearly, is it cyclical? Is it a structural issue? Clearly that, as like ELISE, we're a very long-term shareholder. At the end of the day, you want to have open, transparent communication with management and investor relations. And as I said, really with a long-term approach to the business. Probably a good example for us is something like Superloop. So we were probably in there relatively early, did a number of acquisitions. Like we kind of saw the vision of the business they were trying to create, but the market's impatient. Market likes earnings growth. They want earnings growth, price momentum. And Superloop didn't have that. Obviously done some raisings. And then Paul Tyler, I think it was sort of 2020, became CEO. Just, really got about actually divested a number of businesses, really focusing on the core businesses and doing them well. So, we believed, had communication. We could see what they were trying to do with the business. And then, they won a big contract with Origin in terms of providing, I'm sorry, I should have explained what Superloop is, but a telco company, but providing broadband services and own a network. And they obviously got a significant contract with Origin Energy. And the ultimate vindication for this stock was then you had their major competitor, Australian Broadband, try to bid for the company. So that was an example of a company that, we believed in what they were trying to do, but, again, market's impatient, but if you take a long-term view, you'll certainly, and you believe the strategy's right, you can be rewarded.
Yeah, no, absolutely. Thank you all. Let's move to our second question now. And according to MarketMeter data, only 58% of investors are supportive of company strategies across the ASX 200. Here's an indicative comment from one investor. They said that, quote, the process of guidance appears to be defined by throwing darts at a board. Andy, I'm going to direct this first question to you. What do you do when you don't agree with a company strategy that you're invested in?
Yeah, well, again, if you're in the company and, it can be hard if you're a small minority shareholder, you may not have a lot of influence. If you think there's clearly fundamentally the business is at risk or value, then the obvious thing is to exit it. But then I suppose if you're a more substantial shareholder, and there's probably one example for us, it's probably not our proudest moment, but it's certainly, it's recovered from more at lows, but is like Helios Group we were talking about. They were a bit like Sonic, a COVID beneficiary, got a windfall from all the PCR testing, fortunately squandered it on didn't overpaid for an acquisition, did buyback at an elevated share price. Clearly then conditions have changed post-COVID, things slowed down. A lot of the pathology testing doesn't have indexation. You had a lot of cost pressures in that business, so they got really pincered on their profits, and unfortunately had to do worst fear is do a distressed raising. At that point, we were pretty clearly, we'd been frustrated along the way. There was a major shareholder, Tanara, we certainly supported, they went on the board, so we really agitated for a lot of change in that company. So things like, clearly the management and the chair of the company left, so we certainly pushed, really refocusing that business on costs, optimising their platform. They ended up selling, which was a good business, but sold their diagnostic imaging business, which certainly got a good price for. So ultimately, they're still on the pathway to recovering operationally, but now the balance sheet's in a much better place, in a position to do capital management. But probably wouldn't have wanted to be through the whole ride. But unfortunately, from the bottom, it's they feel like they're in a far better place. But that was an example, I feel like, where we could influence the strategy of the company.
All right, thanks, Andy, for bringing that along. Elise, to you now. What do you do when you don't agree with the company strategy that you're invested in?
We're much like Andy, and in that position where we are able to give management feedback. An example on that front rather, would be Ramsay. Great company, a needed service. However, is there synergies that operate overseas, and is it worthwhile with the French investment that's over there? How do we value that? How do we ascribe value? Is that weighing down the valuation in the market and the perception and the interest below the line and the free cash flow of the quality of that Australian business and the assets, more importantly, the land, the buildings that through the several hundred years, it feels like, these hospitals have been around. I feel as though that's probably an area where it's harder to see the synergies, the return on invested capital, the net tangible assets, just because of that investment. And that's something that we're continually making or have made known, and others are on that same front with us.
So you're still invested in the company?
We do still have Ramsay there because we see the value, as I said, with the Australian assets, but just feel as though perhaps some of those other assets are weighing it down.
Got it. All right, thanks, Elise. And to KERRY, I'll ask you that question. What do you do when you don't agree with the company strategy that you're invested in?
Yeah, I struggle a little bit with this question. I've been in the funds management industry, stock market, for over 30 years. Founded several funds management companies, and the reality with most management, and this would apply to me in funds management, is that I think it's there's an arrogance in the funds management investment industry about this knowing better around strategy. The reality with most of our portfolio companies is that we absolutely believe in their strategy, or we wouldn't be invested in them. As impact investors, what we're seeking to do is engage, work with the management teams to help them succeed in any ways we can. We generally want to be guided by them in how we can do that. So I think I'm going to sort of semi-avoid answering the question. But I guess we don't own the companies that we don't believe in the management strategy. As impact investors, we're there to be aligned.
Have your belief and do your homework before you're invested, I guess, is what I'm hearing here.
Yeah, I guess that's... thanks for my answer, Hans.
I love that, arrogance in funds management. Sometimes the audience says the same thing about journalists when they interview the CEOs, but that's by the by. Let's move on to our next question. According to MarketMeter data, 62% of investors were positive about management across the ASX 200. One positive comment was that management was, quote, collegiate, aligned and engaged, and had an impressive new CFO. I can't tell you which company that is, unfortunately. But there was another comment that also said, it's positive that all C-suite members are made accessible to the market. So, KERRY, I'm going to kick this off with you, because especially with your small cap focus, how important is access to management and your assessment of management in making your investment decision? And I guess, given what you were saying earlier, before you make your investment decision.
Thanks, Hans. So it's certainly at the small cap end of the market is absolutely critical. Effectively we're backing management and often the board in executing on their strategy. So we typically want to not only meet management, often meet members of the board and build relationships with the companies. I mean, our objective is to be, multi-year, ideally multi-decade. I mean, we've been running the portfolio for 8 years. We've got companies which we've owned for 8 years, and we want to be close to those companies. All of the companies in our portfolio are delivering a positive social and environmental impact from their core business, and we want to help them deliver that. A, to generate the financial returns for our investors and other shareholders, but B, to deliver a better outcome for society and the planet. I mean, Tim's here from Critica, and we're a shareholder in his company. He's the chair of the company, and part of the reason we're invested in Critica is to back Tim, and we spend a lot of time with him and know him well, and we're backing the management and board's strategy for that company. So very important to us.
And Tim, hello to you. Andy, I'll ask that to you. How important is access to management and your assessment of management in making investment decisions?
Oh yeah, no, I think it's like mentioned, it is critically important. I think it gives you a better understanding of the actual business you're investing in, the opportunities. Also, a big thing is probably the culture of the business as well, that you can't necessarily gain from just looking at a presentation, but actually understanding, getting, particularly if you get opportunity to see other layers of management, employees within the company. I mean, one example, major shareholding for us, but we think is outstanding from a management perspective. I mean, it's a big company, but Macquarie Group is just, think Shamara and Alex Harvey, the CFO, and the whole management team. It's incredibly entrepreneurial as a company. It's, very, very clearly ahead of the game in terms of a lot of investing in a lot of trends. I mean, clearly they're an asset manager, and with things like urbanisation, you look at decarbonisation, digitisation, like we've seen recently with the air trunk. I mean, everyone else is talking about investing, and here they are, they're already realising assets because they were invested in that like 5 years ago. So a lot of foresight getting into, and the thing as well, particularly Macquarie, is that this is their asset management and principal investing. They really are a creator of assets. A lot of times they're developing assets, adding value to those assets. Great allocator of capital with a strong focus on risk management. But yeah, we think, having met the management gives you, certainly gives you an insight into the culture and the entrepreneurial nature of that business.
All right, thanks, Andy. Elise, the same question to you. I mean, obviously representing a global funds management house, how important is it for you to access that management and I guess be in regular contact with them as well?
I think even beyond representing the house that I do, I think being a technology analyst where you've got no tangible assets, that again means that it comes down to management, the culture, the importance of being able to have that succession planning and that leadership. It comes down to management. And so if you're operating within one of those spaces and sectors, you really have to have not just the person at the top, if I use a WiseTech as an example, that the different levels of management, and it's probably front-of-minded, is their investor day today, but just seeing the levels of management that come through, just so then if you do have any key man risk, you've got that to come in effect there. And access to that, to me, again, is not just who's at the top, but what other levels are there to be able to know that if one person doesn't just execute, that this strategy, this vision will still be deployed.
All right, then, thank you very much. Elise, we're going to begin with you for our last question, which is on ESG. ESG, of course, becoming increasingly important for investors across dimensions such as modern slavery, which we heard earlier from David Macri, social license, the environment as well. Elise, how do you think about ESG when it comes to making those investment decisions, and is there an ASX company that you think does it exceptionally well?
Yeah, again, at Schroders, we take a good focus on ESG, and we actually try to ascribe evaluation to it, both the negative, which I often feels comes more commonly, but also if there's something positive. Oh, it's a great question that you ask there. So one of the examples for that is namely bramble. So it's harder in the industrial space. Everyone just thinks resources when you think negative. So with them, for example, the deforestation that can come from reusing some of their pallets to us is something that is of worthwhile value, and an example as a point in case as to that we should be giving credit for what and where they're going in returns to the ESG component on that front.
Okay, thank you very much. KERRY, to you now. How important is ESG in your investment decision-making process, and what's an ASX company that does it well?
Yeah, I'm going to start by saying that I think ESG risk analysis, is the baseline of and incorporated in. Well, I actually think it's always been incorporated into investment analysis even before the CFA came up with the term ESG in the early 2000s. And again, what we're focused on, because I actually think it is the more important aspect of a company's operations, and I think will become increasingly important in the years and decades to come, is the actual social and environmental impact of their core operating business. This is vastly, vastly more important than how they go about doing businesses. So ESG is the baseline. What really matters is impact. Our portfolio is 50 plus companies, all of which have positive social and environmental impact. So I call them all out as being great companies.
You can run all 50 through right now. No. Only kidding.
I guess, and the problem with ESG is I think we've fallen into a little bit of trap of equating good reporting with good ESG and even environmental social outcomes. So in terms of good reporting in our portfolio, the larger companies are much better at it. They've got ESG teams. I call out, I guess, Arena REIT. But even there, with our engagement with Arena, what we're more interested in seeing from Arena is the quality scores for all of the childcare homes, childcare centres that they own, because we think ultimately the quality of those centres goes to their competitive advantage and the purpose of their business as a childcare centre owner in society.
Thank you very much then. Andy, you get the last word for the whole day, sir.
Oh,
How
thank
important
you.
is ESG to your decision making, and what's an ASX company that does it well?
Yeah, it's certainly critically important for our process. Again, there is so much information out there on ESG. That's the hard part, is being able to decipher it all down and what's important. Again, ESG, there's a lot of information. It's been able to try to decipher that. I mean, clearly you can have the positive aspect that we talked about, but I mean, clearly you want to avoid those big negative ESG events where, clearly various disasters and things that have happened over the time for some of the major mining companies, and then your other governance failures as well, clearly where you can destroy a lot of value in a company. I mean, one I'd probably call out, which I think does a really good job from an ESG perspective, is Stockland Group. You only got to look at what, from a development perspective, very much focused on sustainable development, very much, most of the buildings have, high Green Star ratings. Solar used on a lot of their retail and various operations. I think they're on target to net zero by 2028 maybe, which is, I think well ahead of most of their peers. Socially, they're doing a lot. Again, it's hard, but, things like affordable housing. They're also, in the communities they set up, they're very focused on ensuring that, have appropriate social infrastructure and things like parks, do well in diversity and inclusion. On the governance side, again, I know we talked about, but they do well on the, reporting side of things, the stakeholder engagement and the communication. I think they do a good job there, and it's clearly reflected as well. They get good ratings. They won a number of awards as well. So for us, that's a company we think is clearly doing well in the space.
All right. Thank you, Andy, and thank you, panel. We've got time for, I reckon, about one question. So if anybody has got a question, you can stick your hand up and we'll get a mic out to you. I don't see a single hand. I think we've answered all their questions. Do I not see a single hand up? How about that? Last call. Go on.
KERRY, you make a really good point about measuring impact. How do you measure impact?
Thanks, Michael. Have we got another hour to sit here? Yeah, so thank you. I mean, we publish an annual impact report. We've been doing it for 8 years, so we're about to release our 8th any day now. What we focus on is going through every single one of our portfolio companies, and we use the logic model. So what are the inputs and outputs from that company, and then what are the outcomes and impacts from the delivery of their core products and services. I did the impact measurement course at Oxford in 2018. The opening statement was that philanthropy have been trying to do this for decades, and then the finance industry walks in and goes, "Oh, we can do this." It is extremely difficult to measure the end social and environmental impact. Environmental tends to be a bit easier, but particularly social impact measurement is very difficult. My message, though, is that it is the most important part of what we should be looking to assess from a company's operations. My view is that ESG has gone too far down the box ticking and standard reporting path, and it's becoming less and less valuable as a result. And it even missed sort of the most important thing, which is what does your business do in society? What impact does it have on society and on the environment from its company, from its activities? Our impact report is freely available to everybody on our website, as is our whole theory of how we go about impact investing and impact measurement. So, Michael, please download it from our website.
And on that plug, I think we might as well end it there. Thank you, KERRY series of NorthStar Impact, Andy Forster of Argo, and ELISE Kennedy of Schroders. And thank you to Nick and his team for having us. I think we're about to wrap things up.